Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. Welcome to the Essential Tax Podcast. Hi, Conrad. Welcome to the show.
Thank you. Hi, Mishkin.
Hello. Okay, well, today's episode is going to be talking about cross-border taxation between the U.S. and South Africa. I actually have a lot of clients that have the issue of cross-border tax issues between the two countries. I also have a lot of friends from South Africa that live here in the U.S., and it's a common question I get, like, what are the rules? How do I deal with, all my stuff back in South Africa? How do I deal with the U.S. reporting? What happens if I move back to South Africa? So I thought I would bring Conrad from our Nexia network onto the show, let him kind of give us some of the updates and insights into how that works. I'll obviously fill in on the U.S. side. And without further ado, let's get going. So my first question to you, Conrad, or my first ask of you is, just so that we can acclimate the audience, can you give us just some insight into your background, your education, your licenses, all that stuff, so everyone knows who you are?
Sure, no problems. Born and bred Cape Town, South Africa. Love South Africa. I got a Bachelor of Commerce in accounting. I've got a postgraduate degree in accounting as well. I'm a chartered accountant of South Africa. I'm also a registered auditor, tax practitioner, so pretty much a generalist in the different things, and very well versed in a lot of things, including tax.
There you go. And both our firms are part of the Nexia International Network. How long has your firm been part of Nexia for?
So we've been part of Nexia since the early 90s.
Okay, wow.
So quite a long time. And definitely, and we've been Nexia Cape Town for almost 25 years. So we took on the Nexia name very early on and have been part of Nexia worldwide for a long time.
Oh, wow. That's awesome. That's fantastic. Okay, let's get into some specifics, and we'll start with some general topics and kind of like working out. We'll go up to the heavy lifting here in a little bit.
Excellent.
Just so that our audience understands. So in the United States, when you talk about when does someone become a tax resident, we're a little different than most countries. We've got this substantial presence test, which takes a look at the number of days you've spent in the U.S. over a 3-year period. And I call it the hokey pokey because we take a look at the number of days in the current year times 1, the number of days in the prior year times 1/3, and the year prior to that times 1/6. And then you add it up and you do the hokey pokey. And if it's more than 183, then you're a tax resident. But a lot of other countries don't have that. I don't even know of any other country that has that. But tell us the rules in South Africa. How does one become a tax resident? And then also on the flip side of that, how does one break tax residency? What are your rules around that?
So we do a little bit of real life ordinary residence testing, and then we do a bit of hokey pokey. So let's jump into the ordinary residence first.
Okay.
Our tax laws talk about, where do you live? Where do you go to school? Where do you go to work? Where do you do all of those things? And if you are not in South Africa doing those things and have, there's a court case that talks about, where do you return from your wandering? So, if South Africa is the place that you would leave to go on a short sabbatical of sorts, call it a year or 2 or 3, but return from your wanderings to be in South Africa, that's ordinary residence. So we tax in South Africa on ordinary residence. If you're not ordinary resident in South Africa, then we do the hokey pokey. And our hokey pokey is a little bit different. Ours works on looking backwards. We look 5 years and we look 90 days in each of the 5 years and half of the time in South Africa. So if you fulfill that formula and you're not ordinary resident in South Africa, then you would be a deemed resident. And then you would start talking about double tax agreements and things with other countries. In terms of breaking residence, again, it's quite simple. Where are you ordinarily resident? If I decide to leave South Africa and I never intend to come back to South Africa, the day I left South Africa is when I break my residence with South Africa, or my tax residence. It also breaks on double tax agreements, treaties and stuff. So if somebody becomes a tax resident of another country, the day before that, you're breaking tax resident in South Africa. So there's a couple of nuances to the hows, but it's typically a state of mind and an intention.
Okay.
So often when I debate these conversations with people, it's a period that it could be between this period and that period in the past, because often I'm trying to fix the olden days when somebody left South Africa. So that's kind of some of the hows.
Okay, so just to recap there, you've got ordinary residency, you've got deemed residency, and then you've got a little bit of subjective intent for whether or not they broke that residency and became a resident of another country. The tax treaties seem to play into that too.
Yes.
Okay, great. Now, next topic. The United States operates off a calendar year, and we like to impose that pretty much on everyone else in the world, which can sometimes make accounting a little difficult. How does Australia operate on their tax year? Do they do calendar year or fiscal year?
So SA does, for an individual, it is a 1 March to 28 Feb or end of Feb for an individual. That's the tax year. That can't be changed for an individual in South Africa. Same tax year for trusts. For a company, it depends on the year end of the company. So, if I've got an American holding company buying or having shares in South Africa, they would typically have a calendar year as their end of year, if you know what I'm saying. And then their tax year would end the same time as that. So we don't do anything a little bit funky like the UK, where you end on the 4th or 5th of April in the middle of a month. But we're at the end of the month, but it's end of Feb, and typically the common ones are end of June, end of December, end of Feb. Those are the most common ones for companies, but individuals end of Feb.
So when you end in Feb, when do you pay your taxes? The taxes are normally withheld, and then you pay sometime in March or April for whatever's extra due, or how does that work?
So let's talk as an individual. As an individual, you have a pay-as-you-earn deduction every month. So if you're earning a salary, they take away from salary, and that has to be paid over by the company by the 7th of the following month. So each month, somebody gets a salary, they deduct something, that goes off to the revenue authorities. Then if you are earning other styles of income, let's call it you have an investment property and you're making a profit on that, and you've got to pay tax on that. That is paid twice a year, end of August and end of February. And then a top-up gets made 6 or 7 months after year end before interest starts getting charged. But you have to, in your provisional returns, get within a certain accuracy to avoid penalty taxes,
Right.
if that makes any sense.
No, and that's similar to how we do estimated taxes in the U.S. I guess the point that I'm trying to draw there is for U.S. citizens, or U.S. taxpayers living in South Africa. I think for your tax return, you need to be really careful about how you're doing your foreign tax credits. Most all U.S. taxpayers default to this paid method, which means we only capture the credits or taxes paid within a calendar year. Whereas if you're in South Africa, you may want to consider switching to a fiscal year. Or you're in a fiscal year, you may want to switch to an accrual method of foreign tax credits. And then that way you can take all the taxes paid that relate to the calendar year on your U.S. tax return. You also may need to resource some income under the treaty to make sure that you're not being double taxed. So that's an area that I think if you're a U.S. taxpayer living in South Africa, you definitely want to talk to U.S. tax advisors and make sure that you get that straightened out, and obviously coordinate that with your SA tax advisors. Let's go on to a different topic. Let's talk about sourcing of income. And I just briefly mentioned that for the resourcing rules under the treaty. But, let's talk about the sourcing of income rules in South Africa. How do those typically work? So if I'm living in South Africa and let's say I'm operating a U.S. business, or I've got a U.S. brokerage account, or I'm earning income, like how do your rules work to source the income? Is it domestic source, foreign source? How does that work?
So if you're an individual and you're living in South Africa and you are spending the better part of the year here, and you're an employee of a foreign company, you're going to have some taxes payable in South Africa because it's sourced and earned in South Africa. If you're under I think it's the 183-day rule. So if you are doing it for a very short period of time, then it doesn't get through the tax treaty to be sourced inside of South Africa. And I am speaking on a person that is not tax resident in South Africa. If you're tax resident in South Africa, it's very simple. You're tax resident, worldwide income gets taxed here.
Right.
In terms of a company, if you are a registered South African incorporation, you're definitely taxed here. If you are let's call it a foreign branch in South Africa, then there's all sorts of checking here, checking in the US, and seeing how it all works. But if you've got a place of business and a permanent establishment in South Africa as their branch, well, then you typically have to pay your taxes here, and you have to earn a reasonable amount of the income for the business in South Africa. What is reasonable? It's a very difficult answer, but we have a lot of different treaties around the world that kind of try and help with define what's reasonable. So
okay. And do you have court cases that also help define what's reasonable there, or other standards that you can measure that against?
So we use the OECD model. So we do use the international model, which is generally market value. What is the market value? But when you've got a branch, what is the actual market value of what that branch does for your business? Very difficult. So often the people in South Africa would end up with a cost plus approach, which is not what our revenue authorities like, but it's what they accept because there isn't a better method. And typically they are saying that they want a minimum of 5-6% cost plus, and ideally 10 cost plus 10, unless they can say that branch in South Africa is doing a majority or a bigger slice of the worldwide intellectual capital, usage and stuff. So a lot of variables, but certainly, if you've got a small little branch in South Africa, cost plus approach is often what happens.
And I'm not sure if you can answer this, but in the United States, we typically, when we're dealing with clients that have those cross-border services, our rule of thumb is you got to go get a transfer pricing study. Like, we won't even touch your tax return unless you have that in place, because the IRS has really done an about face and really auditing people left and right. They're really coming hot at, and if you don't have that set up in your file, like you don't have that transfer pricing study on the US side, then the IRS can really adjust that however, it gives them free will, and that creates a bunch of issues. Do you advise folks in SA to get transfer pricing studies done, or is there a light way of doing it, or how does that work?
So Mishkin, of any substance of size, 100% you get a transfer pricing. If you were talking about a smallish piece inside of South Africa, so size is important to contextualize. If you're talking about 10 million rand or less in turnover, or something really small like that, you don't go down that road. If you're talking several 100 million rands worth of turnover in South Africa, 100% you've got to go down that road. So definitely depends on size as to where I would encourage a client to go to and things like that.
Okay. So my big takeaway is, if you're going to set up a branch or some kind of cross-border entity, you really got to plan that out specifically. You got to look at the treaty. You got to look at your transfer pricing studies, get all your ducks in a row before you really start doing business. As you know, we get a lot of clients that kind of get all that set up and they don't talk to us, and they've got all this movement back and forth between the two countries, and then we're trying to fix it after the fact. But really, it sounds to me like the best way is that there needs to be kind of a checklist of things done before you start your cross-border operational entity.
And very important. I mean, typically the people will end up, after a conversation with me, ending up having a subsidiary company in South Africa.
Really?
It certainly ends up being the simplest approach to the whole thing. When to take a branch and try and get a branch a bank account in South Africa, it's not easy. Whereas if you take a South African company to get a bank account, you walk into the bank, you take your documents, and you walk out with a bank number. If you understand what I'm saying. So. Yes. Some of the practicalities stifle people not doing a company, and they end up going through the corporate approach because it suits. Different things work for different people, but often that's the conversation we have when somebody wants to set it up, and we often end up with a corporation.
I see.
We call it a PTY limited, proprietary limited company. But I would imagine it's a small corporation in the US of sorts, whatever you want to call that.
Yeah, well, it would default to probably some kind of controlled foreign corporation. Now, U.S., we have the check the box rules, so you could elect it to be a disregarded entity. So that's where the planning comes into play. It sounds, though, that what you're saying is that not only from a tax perspective, but just ease of doing business, the subsidiary is probably better than the branch. Is that true? If you, for example, you had a U.S. parent and an SA sub, and I'm trying to move money back into the U.S., would you say that it's easier to get money out of South Africa if you have that kind of setup as opposed to a branch?
100%. Because, for instance, one of the rules to try and get money out of South Africa is you need to have a share certificate that's endorsed. Now, if you've got a branch, there's no document to get endorsed to try and move money. And we have foreign exchange regulation that controls any movement of money into and out of our country. So once you've sent money into South Africa and you've made profits, to move the money outside of South Africa, it definitely is more trickier to move it out, and in an incorporated environment, much easier to do that.
Okay. And along those lines, so my next question along those lines, so in the United States, we don't really have these rules set up. It's coming, in my opinion, and we're starting to get more and more along this line. But there's what they call the KYC rules, know your client, which is very common in a lot of other countries. And so when you're dealing with, for example, I refer you a client, right? I'm assuming the first thing you do is you have to do your KYC checks. Can you describe a little bit about that process and what that looks like and why that's the case?
So we in South Africa were put onto a grey list a year or so ago. So our policies and procedures with regards to knowing your client have gone extraordinarily high. Okay. And what that means is for an individual, if I've got to do business with an individual, I've got to know the person. I've got to have met the person. I need a document to prove who they are. Let's call it a copy of a passport. Or in South Africa, we use an ID document, an identity document. It's now a little card, but used to be a book. You also got to know the address. The address has got to be a proof of residence of sorts. And with today's world being so much electronic, it's very difficult to get a physical address on documents all the time. So we used to only accept rates bills, which was like a council tax bill, where now they are accepting your bank accounts that have addresses on them, or cellular contracts that have addresses on them. So that's the address parts. If you so that's the general one. So that if you walk into a bank, that's typically the things you'll have to do. Another item that happens on a banking level at the moment in South Africa is we need to tell the bank whether we have dealings in the USA. So it's very interesting. No other country in the world, but if you open a bank in South Africa, you got to say either I don't have any dealings in the USA, or I've got to say that I have these dealings and this is my tax number and that. So very interesting.
Yeah, I believe that's because of the FATCA rules, right? I think the Foreign Account Tax Compliance Act, maybe that's their interpretation of what they need to do under their model IGA agreement for disclosure back to the U.S., which is really funny because in the U.S. FATCA is so one-sided. We don't question the South Africans living in the U.S. and say, oh, we're going to send that back to SA. We don't do that. We don't play ball, but we expect it from SA back to us.
So it's the only country we sign a document about when we open a bank account. Typical, and you know your client is pretty much everything. If I want to buy a cellular phone, I've got to do the same things. If I want to transfer property, I've got to do the same things. If I want to open a bank account, I've got to do the same things. So it's pretty regular in terms of that. The banks and the insurance industry have taken it just a little bit higher in terms of the level, so they ask a little bit more documents and more authenticity to things. So some of those people will say, I want a notarized passport or a certified ID by a commission of oaths. Oh, wow. Not everybody. So not everybody does that. If you're dealing with our revenue authorities, and our revenue authorities are called SARS, South African Revenue Authority. So if I talk about SARS, that's what I'm talking about. So SARS, if you want to appoint a representative person for a company, the person in charge of the go-to person for our revenue authorities, you would give all those same documents. You would also have to, in the post-COVID days, send a photograph of your ID document with a little note saying, this is what I'm doing and this is what I want to register. So that, because we're not walking into a revenue authority every day anymore to do things since COVID. So that's an interesting nuance to it. But yeah, so definitely know your client everywhere you look, left or right. You've got to do know your client checks everywhere.
Okay, and just for practicality purposes, if I want to become your client and you say, well, look, Mish, you got to do all these KYC things. How long is the timeline on that? Is that a couple days? Is that a week? Is that 2 weeks? I'm assuming I can go get you all the information you need relatively quickly. What's the turnaround time normally look like?
So in terms of my own business and in terms of tax, I want a copy of your passport. I want a copy of your proof of address, and I want to see you in person on a video. So okay. I can then compare the video that I'm seeing to the document that I'm seeing, and then I know then I've got a fair idea of who I'm dealing with. Somewhere in that, I have to assess risk in terms of what type of client I'm getting versus, in South Africa, quite a lot of the banks are now asking, are you a prominent official? Are you a politician? Are you a lot of those things? And rightly so, because we've had a little bit of a checkered past in the last few years of not good people dealing with things badly.
I see. Okay. And is that in an effort to get off the gray list, or is that just a general overall push for
a bit of both? So
okay.
Definitely, we were put on the gray list, I think 2022, ballpark 23, that kind of range. So we've introduced a whole lot of things where in South Africa, a director of a company was registered at our company's house, whereas a shareholder was not. So we've introduced the shareholding level to go to the company's house, and as a trust, the beneficial owners of the trust need to be registered at the Master of the High Court and things. So we've gone down a road where we have made sure that the shareholder and the beneficial ownership level is also sitting in places where people can access them with the right authority.
Okay. Let's go into a big topic that I think all the listeners to the podcast, or some of the listeners to the podcast, would be super interested in, which is let's take a hypothetical scenario and assume you have an individual from SA going inbound into the United States. And let's assume they've got a brokerage account, they've got a provident fund, they've got a preservation fund, they've got retirement annuities, they've got a trust, they've got a PTY limited. Now, if they were to set foot in the United States and become a U.S. tax resident, either under the substantial presence test or the green card test, I can tell you from the U.S. side that a lot of those things would blow up their U.S. tax return would just go from this little thin tax return to this massive filing. The compliance costs would be enormous. You'd be dealing with our PFIC rules, our foreign trust rules, our CFC rules. It would be just a super, super complex filing. Let's go one by one on these things. So brokerage account. So typically the United States tax code, we dislike a U.S. person, again, individual satisfying the substantial presence test, green card holder, citizen. We don't want that person to hold foreign mutual funds. We want all of that through Wall Street and the U.S. mutual fund industry. So first step when I get someone from South Africa is, do you have a brokerage account? And if they do, I want to see what are the operating companies, what are the passive companies. We typically ask for the ISIN number so we can look up the holding. What's your take on that as far as, do you ever have people come to you and say, well, I'm going inbound into the US and I have this brokerage account. What do you think? Do you see a lot of that happen? Do you have a take on how they should approach that? Should they rebalance before they leave? And any thoughts on your end about the brokerage accounts?
So let's jump on those things. So in South Africa, we don't often have a brokerage account. A brokerage account to us is I might own an investment in a unit trust fund. So we call it something like that.
All right.
Also, when we cease residence in South Africa, so the day that you end up becoming a US tax citizen is the day that you have to have a sale of all your assets in South Africa at market value. So if you're going to sell them all at market value, often the people actually dispose of them before they cease residence to trigger the capital gain and tax cash with them and then invest them in another place in the world. So not often do people leave something like a brokerage or a unit trust fund in South Africa because, one, they've got to fund the moving to the United States. So that doesn't happen too often, but you're going to pay tax on the ceasing of residence at the market value less what your base cost, that your purchase price is your base cost was. But certainly there are many people that leave South Africa with a retirement annuity or a pension fund or a provident fund, because you can't easily exit those as you can with a brokerage account. So a brokerage account is pretty liquid. Not dissimilar to a bank account in South Africa. You can give an instruction and within 5 days you got the money in your bank. And certainly if you're ceasing residence and you are never wanting to return, you can deal with your taxes in the exit phase, and do it all as one. There is no reason that you can't keep it, but certainly it makes sense at an exit stage to be winding up things like a brokerage account and a unit trust fund account, and moving that monies to another place in the world where the investment horizon is wider.
And is it easy to then, once you've wound that up, to then transfer those funds to the U.S. if you're moving inbound to the U.S.? Do they allow you to do that?
So in South Africa, you can, as an individual, take 10 million rand on application, and it's quite a simple application. It takes a 21-day turnaround time to be able to take 10 million rand out of South Africa as an individual. You can take 1 million rand without any application. So if you're taking really small amounts of money, you don't have to do an application, you can go. If you are emigrating and ceasing residence, then you can make application to do greater than 10 million rand, but it takes a bit longer. If you are leaving, you can take 10 million rand per year. If you're leaving and you cease residence today, I can still take 10 million rand every year for the next 5 years. Okay, and that application process is not difficult. It just takes time. It's a 20 day process, 20 working day process, and it works on a calendar year, Jan to December. If you're taking amounts larger than that with you, then there's a bit more planning and forethought that you need to do that. We often find, so let's jump into those other couple of things: the retirement annuity, a preservation fund, a provident fund, and a pension fund. Let me define all those terms for you, and let me tell you.
Because those are like, I say, do you have a retirement account? And like people from SA look at me kind of blank. And then I have to say, well, wait a minute. I'm really talking about a preservation fund, a provident fund, and a new, so there's these different slices, and they're hard to kind of distinguish. Can you, walk us through that and give us the details on it?
So let's talk all four of those things. So typically when an employee in South Africa works for a company and gets a salary, part of that goes off to a pension, and it's called a pension. And there's tax consequences, I'll jump to later, but that's a pension.
All right.
A company can also decide. So pension is a defined end value style product. So you put money away into a pension, and one day when you retire out of that company, they will pay you X amount times a salary. That's the style of what a pension works. Okay. A very similar product is a provident fund. Okay. Also a deduction for a company inside of a company structure for an employee. Okay. But the provident fund is, I put 100,000 rand away and I get 100,000 rand of value in this, and it grows in there and it's always mine. So when I retire one day, whatever I've put in plus its growth is mine. So it's not a in salary times a number of years or a formula to work out what it is. So both a pension and a provident fund are styled products that are company deducted and work around in a company's environment. So I've got a business in South Africa. We have X amount of employees, and they're all part of our provident fund, and we deduct off their salaries and put that away into their own provident fund style accounts.
Okay.
In the 80s, 90s, the pensions were the big thing. Since the 2000s, when you would like to know how much you're getting, how much you've saved, and be able to calculate your wealth as you go, provident fund have become the style. So where maybe in the 80s it was an 80-20 in favor of a pension versus provident funds, now it's probably 80-20 in the opposite direction, 80% provident fund and about 20% pensions. And neither of them are disappearing because there's legacy things in both, and they will always be around. Then we have two other products that you'll hear when people move to the US, an RA and a preservation fund. Let's talk preservation fund, because preservation fund is exactly the same as a pension or provident fund. It's just when you want to move somewhere, and you say, you know what, I'm preserving this pension fund or this provident fund in a state that it can carry on growing, but in an investment vehicle that I don't have to pay tax. So let's say you've built up over a few years 5 million rand in a pension fund, and you decide I'm going to the US. You can't keep your money in that pension fund because it belongs inside of a realm that only the company can own. So you've got to take it out. But you don't want to take it out because you don't want to pay taxes on it. You don't want to do all sorts of things. So you go to an insurance company, say, listen, I want to move this into a preservation fund. I want to preserve this in its form. I want you to invest it in this style of an asset because you get quite a lot of choice on what the risk profile must be, and you preserve it. You pay no taxes at that point in time. Okay? So that's what a preservation fund is, and that's why people coming into the US have a preservation fund, because they were pension funds or provident funds that ended up in preservation funds.
So that's your version of a rollover? Would you call that a rollover? Okay.
You kind of roll it over and you preserve it in its format. So you could be investing in equities and bonds and all sorts of things you guys use a brokerage style account to invest in different platforms like that. We use a unit trust fund, but preservation fund is no different to that. And you don't pay any taxes while it preserves.
Okay.
If you ever exit either the preservation fund or pension or provident fund before the age of 55, you've got a whole bunch of taxes. Okay, because then you are withdrawing, you're not retiring. So in our tax world, a retiring age is 55. So after 55, you get beneficial tax rates, but you still pay taxes to take money out in capital lump sums. I'm going to jump back to those three products shortly, but I first want to just jump into what an RA is. So we have this colloquial term RA, and all it means is retirement annuity.
Okay.
It is very similar to a pension and very similar to a provident fund, except it's from an individual. So as an individual, I can walk into an insurance house and say, listen, I want to contribute this amount of money per month, and I want to start a retirement annuity. And I want to invest it in this style of risk profile. This is where I'm at. And you start a retirement annuity. A lot of companies will actually say to their employees, we don't do a pension or provident fund. We would prefer you to have your own retirement annuity. Here, start one. But as an individual, you can do exactly the same. All of those three products, including the preservation product as the fourth product, is a saving for retirement one day. Okay. And we've had some tax laws that have changed recently to force people not to take all out as a lump sum, and force people to buy an income stream for the future. In South Africa, we call it an annuity. Okay. So some of that money is then used to fund a monthly income stream out of that insurance house. Okay. And in that, you don't get taxed if you move it into that product. If you take money out as in a capital lump sum out, before retirement, you're going to pay certain high taxes. After retirement, you're going to pay certain lower taxes. If you use that money to buy this future income stream called an annuity in South Africa, you don't pay tax on that. You pay tax when you receive the monthly money as if it was a salary. Okay. So all four of those products are very similar, and about 5, 6, 7 years ago, they joined the taxable deductions that you are allowed to put into the pension, the provident, and the retirement annuity, because the preservation is just holding something. It's just a holding pattern. So in South Africa, we have a situation where as an employee, you can deduct up to 27.5% of your gross remuneration or salary or a couple of things to a maximum of 350,000 Rand a year, and get a tax deduction, which is your marginal tax rate.
Okay? Oh, wow.
So your marginal tax rate for an individual anywhere above a 700,000 Rand annual salary, which is not a lot, it's not a crazy amount of money, is 41%. So any semi-high income earning person in South Africa can pay 60% of a product and get 100% in value, at least for the time value of money that you're in the product. Okay. Wow. So if a 30-year-old starts putting his money away in those style products, he's putting, for every 60 Rand he's putting in, he's getting 100 Rand in value. Okay. So if you can do that for 20 years, certainly at SA's inflation rate of around about 5, 6, 7% regularly, that's real money. So they have jumped on what the different types of products are, the deductions you can get as an individual annually, as well as what the naming and why you will often see a person with a preservation fund.
Talk to me real quick about employer contributions. I assume there's no employer contributions to the first product, which is the pension. That sounds like a defined benefit plan, although there may be. And I assume from what you said, the employer doesn't contribute anything to a retirement annuity. Do they contribute to the other two, or where can an employer, if an employer's going to, can an employer do matching contributions, and if so, which products are they doing that with?
So a couple of things. Any of those 4 products, let's exclude the preservation fund because it's just preserving. So any of the 3 products, any contribution that a company makes on your behalf is a fringe benefit. So it makes no difference whether you contributed or the company contributes it, it's still taxable income. In South Africa, about 10 to 15 years ago, we moved to a cost to company style approach for employers. So if I have a cost to company and you're going to get 100,000 Rand a month in terms of a salary, I'll say, well, you're going to get a 90,000 Rand salary. I'm going to contribute 10,000 Rand to your provident fund. So your cost to company is 100,000, but you've got to match my 10,000 Rand that I put into your provident fund. So you're going to get a gross salary of 80,000 Rand. And I write this on a piece of paper. And for all intents and purposes, you're going to be taxed on 80,000 Rand because the gross income is 100,000 Rand, but 20,000 Rand is the tax deduction. And you're entitled to claim it monthly. So you don't have to wait to an annual tax return to get that provident or pension deduction. If you are, the company contribution versus you, it actually makes no difference because it's all part of the same pot and called cost to company. If you have a retirement annuity which you have managed, you can go to your employer, show them the document and the contract, and they can deduct that monthly off your taxes, and you can get the tax benefit on a monthly basis as well for a retirement annuity. So for all intents and purposes, from a tax point of view, those 3 products are identical. They're cumulative. So the 350,000 Rand is not per product. It's for all 3 together per year. It's 27.5% for all 3 products added together per year. So they are different style for different reasons. But for tax purposes, we have consolidated them into one style product probably about 5, 6, 7 years ago.
And is it usual for an employer to match an employee's contributions, or is that atypical? Like it doesn't normally occur?
So I don't see that in salary packages almost ever in South Africa because we talk about a cost to company. When I advertise a post, I say the cost to company is going to be 100,000 Rand. Our rules of our company are that 10,000 of that comes from the company that gets deducted, and 10,000 comes from your contribution that gets deducted. So your net gross salary is 80,000 Rand. So it actually doesn't matter whether I'm contributing, whether there's 20 that the rules say 20 goes in or 10 and 10. It doesn't matter because we actually advertise employee posts as cost to company. So
okay.
And typically the company would say, these are my rules. So for instance, in our own business at Nexia, our rules are that 14% of the person's salary goes towards that retirement provident fund. That's our rules. We've decided that is a reasonable and an acceptable number. So any employee that joins us, that's what comes out of the pot before you get to your gross pre-tax taxable income.
I see. Okay. Yeah. The reason why I'm asking this line of questioning is because we have very antiquated, draconian rules on foreign pensions, foreign retirement plans, which really need to be updated. There's a whole kerfluffle currently in the U.S. on that topic. There's a hearing actually in August of 2024 related to proposed foreign trust regulations, and a lot of the griping from the tax practitioner community was around the IRS position on a lot of these foreign retirement plans. And I can tell you that a lot of these, from a U.S. perspective, create headaches because you really don't. If you're from SA, you don't want to exit the product, but when you bring it into the U.S., several of these may constitute what we call foreign grantor trusts, which create a lot of filings. We also look through the product, we'll tax it, whereas you won't tax it in SA. So it creates this little imbalance. And there's nothing under the treaty that fixes that, unfortunately. I can say that under my investigation, though, the retirement annuities, I believe those to be more of a contractual basis and less of a, I wouldn't look at it as a trust. A lot of people would look at preservation fund and the provident fund and the pension we would classify that in the U.S. Mostly as trusts. But the annuity we look at as a contract, so that may be a saving grace for the retirement annuity. Okay, moving on, because we're going to run out of time here. Just very quickly, inbound, when you're leaving SA, going inbound into another country, let's say the US, briefly talk about trusts and your PTY limits. Are you required to get rid of those too, just like you are the brokerage account, or can those stay? What's your general advice on that?
So exiting South Africa, you as a trust, and typically our trusts are discretionary family trusts. That's the common one that happens in South Africa, where you want to separate your assets and use the tax effect well to your family for a trust. And depending on what country you go to, if they don't have the draconian US style laws, often the people are keeping their trusts. Okay. It does get a bit more trickier because there's tax benefits to a South African individual being a beneficiary of a trust. The tax rates are almost halved. As soon as you become a foreign beneficiary of a South African trust, they tax the trust on a CGT event at the trust tax rate. Now,
and CGT being capital gains tax.
Capital gains tax, 100%. So, and trusts are typically there to hold capital assets. Okay. So when you dispose of those assets, if you're a South African or have a South African beneficiary, you are going to vest that money with. Our maximum tax rate sits at 18% in South Africa. But if you are vesting that income in a foreign beneficiary, that tax for that capital gain suddenly jumps to double that, 36%. So if somebody is going to if somebody is not going to leave the trust for South African beneficiaries and they're going to want to use that money for themselves overseas, it makes sense for them to consider exiting the trust because the tax rates are half right now before you leave. Okay, so that's something to consider. The income that you earn in a trust, it's 45% straight, whereas an individual, you only get to the 45% threshold at 1.66 million rand a year. So, you also as leaving the money inside of the trust and the income inside of the trust, the tax rates get punitive. So typically, people would try and style their trust differently, either to leave it for remaining beneficiaries and potentially figure out a way so that the remaining beneficiary can get the benefit from the trust, or they would dispose of assets in a trust. That's commonplace. In terms of the company, South Africa would, if you exit in South Africa, often the people would typically exit the companies as well, because it makes sense from a controlled foreign company style laws to exit the company as well. They typically are the better routes to go, but not always in every case. So it's not a one size fits all kind of a scenario, but certainly those two things are there. So that's the company and the trusts. What other vehicles were you asking me on at the beginning of that?
No, I think that kind of summarizes the inbound into the U.S. Now, just one last quick follow-up question before I go on to the second big topic. If I don't exit the trust and the companies, is there still planning? I go inbound into the U.S. I'm a U.S. tax resident. I guess you're now considered a foreign beneficiary for trust purposes, but is there still remediation and planning that you think is needed at that point in time, and things you can do?
I have found that with all my clients, that certainly the ones that are residing in the US, the taxes that they have to pay for the controlled foreign company. So if a US citizen owns 100% of a private company here, all of that private company gets taxed in the US citizen's tax return, I believe. That style. So it makes no sense that the taxes get paid inside the corporation and then in the individual, because where does the double tax treaty help you? Because it's not in the individual in South Africa, it's in a company. So it gets messy, and that's often the triggering event to say, you know what, if that's the case and I'm going to pay the tax twice, let me rather try and exit. And if they're going to exit, it makes a lot of sense to plan, be planning your exit, to time your exit out of entities in the right time, because it may not, if you're in a property, if your company owns a property, a simple property company, and it's in a property a lull in the market, it doesn't make sense to be selling it. You got to time things and where and how you want to do things. So a lot of things to consider if you're going to uproot yourself and certainly go to another tax jurisdiction in the world, especially the US. And I have found, having had a few US clients, that they don't like to want to be involved in any trust because it gets very messy. They don't mind as much to be involved in a company, but don't like it. So that's my experience so far.
Yeah. And I get that 100%. I mean, we see that all the time because the U.S. foreign trust reporting, the rules are very draconian. There's a 5-year look back prior to the time that you enter into the U.S. So basically, it's really weird. Like, we're imposing a rule like says, hey, you have to know that 5 years before you're going to enter into the U.S. and then style all of your transactions with the trust to meet our rules to comply properly. But most people obviously don't have that type of crystal ball to say, oh, in 5 years, I'll be a U.S. tax resident, so I'm going to comply with all these rules that we have. The reporting itself, the forms 3520 and 3528 in the U.S. are really difficult to prepare. The cost compliance is enormous. We don't have the same rule. Like you said, there can be disparities where you're paying tax at the corporate level, and then in the U.S. you're paying it at the individual level. So then our fix is that there's a 962 election, maybe if it's a CFC, or there's a check the box election to make it a disregarded entity. But then that carries its own problems because you have a deemed liquidation of the company into the disregarded entity, or the income is passing through to the individual on an annual basis, where maybe it's just accumulating and being paid as a dividend in some later year in NSA. So there's all sorts of, like you said, messiness and stickiness there. Okay, let's go on to the next big topic. And I think you talked about this earlier we talked about the cost plus and a U.S. entity having a branch or a subsidiary. But talk to me about your experience with individuals, U.S. individuals moving inbound into SA. What are some of the things that you're seeing there that, if for example, I referred you a client tomorrow that said, hey, they're a U.S. person, they're coming inbound into SA, what are some things you're going to want to ask them about or know about or try to guard against?
So there's not too much from an SA point of view that gets messy. What I do ask them is make sure you know what your market value of your investments are on the day you become a South African tax citizen, because that is your base cost for when you either exit South Africa or you sell the asset. So it's very important to have market value of all assets. If it's property in another place in the world, I'm assuming that they would keep their own jurisdiction on the property, but certainly brokerage style accounts or the investment in shares or private companies or whatever the case is, that's very important to have. And know that when you come to South Africa and become resident, that you're going to pay tax on worldwide income. So let's say you come to South Africa and you've got a brokerage account, and that brokerage account has doubled in value from the day you walked into South Africa. Well, you're going to pay tax in South Africa on that doubling in value at capital gains tax rates. Whether you are paying those taxes in another place in the world or not, because of it being located there. So you got to definitely understand the place that you're leaving and what their tax laws are once you're not a resident in that country anymore, and what their sourcing rules are. But certainly from a South African point of view, if you become a resident here and you're going to take up ordinary residence, market value is critical, because that's what your capital assets, when you sell them, are important at. And then, you do pay tax worldwide. You pay tax on worldwide income when you're a resident in South Africa. So that is something to understand and know.
Do you ever see U.S. people that come to you that have just been reporting South African income but fail to report, their brokerage account back in the U.S. or a rental property they have back in the U.S.? Do you see that?
So most of the people that come from the US to South Africa are quite revenue smart, and I think that's because in the US the revenue is quite. If you get on the wrong side of the revenue, you're in big trouble. Right. So certainly in South Africa, our revenue authorities have caught up in the last decade by issuing a lot of people a lot of heavy duty fines and stuff. And maybe the earliest type of people that I could remember our revenue authorities going and trying to arrest is as recent as 2015 to 2020. Before that time, you got slaps on the wrists. in terms of you pay taxes, you pay penalties, but you never actually go to jail for being bad and not declaring taxes. Whereas in other places in the world, it's a bit more heavy duty in terms of not doing it. So typically, and again in South Africa, our tax compliance on certainly on the people that become our clients is very high, because that's what we tell them. These are what the rules are. This is how you do it. This is what you've got to, these are the taxes you got to pay. Here's where there's an element of discretion on a deduction that you can claim. That's what you can do. And certainly in the last decade to 2 decades, our individual area, our tax authorities have taken away the ability to do significant planning inside of a personal space. You need to involve a corporate or a trust or something like that to be doing any kinds of decent tax planning in South Africa.
So in the US, the last question I have here, in the United States, we require our tax residents, citizens, green card holders, to do what's called international informational reporting. And specifically what I'm talking about is report of foreign bank accounts, report of, specified foreign financial assets. So, if you come into the US with SA bank accounts, the preservation funds, all of that, there are these really special forms that carry these massive penalties, the FBAR, the 8938. It's $10,000 plus for failure to file. It's information only. In the reverse, in South Africa, do you guys have anything like that? Where, for example, I have bank accounts back in the US, where I have, maybe even not in the US, maybe I have bank accounts in other countries. Do I need to report my foreign financial assets in South Africa to the SA authorities?
So as an individual, our tax return is quite similar for most individuals. There's very little that gets that is crazy different. There are, if a section applies to you, you've got to fill it in. Okay. We only have to declare assets and liabilities in certain cases. So if you're a director of a company, you have to declare assets and liabilities. If you run a business in your own hands, you've got to declare assets and liabilities. If you have non-employment style income of a certain level, you have to declare assets and liabilities. As soon as you're declaring assets and liabilities, there's categories for foreign. So at this stage, you've got to put that on. If you're, and very recently, being the 2023 February return was the first one where our revenue authority said, if the market value of your assets worldwide for a resident is over 50 million Rand, you need to give us the market value of these assets.
Of each asset, specifically.
Of asset classes. And they excluded a primary residence. So it was mainly listed securities of whatever type, investments in your private companies, the types of assets that they could go down a road and say, well, okay, this is a high value individual. I need to look carefully at him. He's going to pay me a lot of taxes. Okay. Because our assets and liabilities that go on a tax return are at cost. Okay. So if you bought a property 40 years ago, it could be a 50,000 Rand property, but today it could be a 10 million Rand property, if that makes sense.
Right.
If I bought shares in one of our bigger companies listed on our stock exchange, let's call it Anglo American, it's a mining house. If I bought that in the 70s, I was paying a couple of thousand Rand for those shares, and today they could be worth millions of Rands, if that makes sense.
Yeah.
So certainly for the old wealth, they're wanting to know what the wealth is worth so they can decide how best to treat that person. And I want to add just a little smidgen to that one as well. About 2 years ago, they opened up an individual high net worth department in our revenue authorities, and they invited you to join them, where you could get good service from them at a quicker response rates. But in all intents and purposes, it was to make sure that they treated the gooses, the golden gooses, really well, and they got their money out as fast as they could.
Wow, that's awesome.
So very interesting. And you know what? They actually give good service to those people. I like the service they give, but are they paying for that service in 100%? They're paying a lot for that service.
I see. Okay, so you get what you pay for there. All right, last big topic. Yeah, last big topic here. Talk to me about, because I believe, one of the things that kind of is on my radar whenever I speak to my SA clients that have been in the US for a while, I always tell them, I'm like, I think some of the laws in SA have changed recently. Perhaps they're holding a preservation fund or whatever it is, whatever assets are back in SA. You may want to get a hold of Conrad and just have a quick run through of, did you exit properly? All that stuff. Can you just give us the 50,000 level view of any recent changes that have happened in SA over the last couple of years? And then is there anything on the radar that the folks listening in the audience should think about or be aware of that may be changing in the future?
So I'm going to maybe suggest two laws that have changed. One is a tax law and one is a non-tax law. In September of 2024, we have just brought in a new law with regards to pension and provident funds and retirement annuities, where the law is that they split a savings portion from a retirement portion. And that going forward, you will be able to access one day so in the past, when you left a company and started a new job, you could exit your pension or provident fund and take all of it and cash it in and pay high taxes. From September 2024 going forward, you will now only be able to access a savings portion, which is typically as little as a third of that big pot going forward. So you won't actually be able to extract out pensions and provident funds. So in 10 years' time, you won't be leaving a job and starting a new job. You won't be able to access a big chunk of your pension funds or provident funds if you're not of retirement age. Okay, so they're forcing people to save for retirement. Principally, a good idea. How it's rolling out, very interesting. A lot of commentators will say good and bad things about both sides. What they have allowed in the transition is that up to a certain date, the history, there's going to be put into this vested account, which means that it is not forming part of the new rules going forward. So there's things there to talk about. I think the other big law that changed, which affects definitely your and my clients, being people that are expats from South Africa or USA people, is that around about COVID, they changed the tax law and said that if you are outside of the country, the income that you earn in that foreign country is not fully exempt anymore. I call it the people that went on the ships. If you spent a certain amount, the oil rigs and the ships, if people spent a larger portion of the year outside of the country, they weren't taxed on that money. So they changed that tax law to be the first 1.25 million rand of that foreign income. Now, with a 18 to 20 exchange rate, that's not earning a lot of money outside of South Africa before you get taxed. And what that has done is it's made people that left South Africa in the 90s or the 2000s or the 2010s, but didn't do a formal immigration out of South Africa, re-look at their things, because while the money that you earned outside of the country was fully exempt, they thought they were safe, if that made sense. So there's been a lot of people that have come out of the woodwork and say, well, I didn't financially emigrate out of South Africa, or I didn't emigrate, or I didn't do a proper ceasing of tax residence out of South Africa at the time, because I didn't really have assets, and I just left the country and things. So we've found quite a lot of people coming to us and saying, can I cease residence properly and get a document to authenticate that I've ceased residence? And my answer to them is always absolutely yes. And then if they left in the 90s or the 2000s and I've got documentation to prove to my revenue authorities that is when they left, we can get an effective date on that ceasing of residence. I did a client very recently in 2022 where we ceased her residence in the late 90s, because that's when they actually left South Africa and went overseas. And then our South African authorities can never actually come to you and say, you must pay tax, because you've got a document that says this is when I left. Whereas if you don't do it properly and you leave the country and you're still sitting on our electronic e-filing platform, at some stage they can start saying, you should render me a tax return and start penalizing you. And how could that be a problem for somebody in the future? Well, if you're living in another country in the world and you never come to South Africa again, it's not a problem. But if you ever come to South Africa and our revenue authorities by that stage have linked up, an ID number or a passport number to the revenue authorities, all sorts of havoc can happen. So certainly a good idea to exit South Africa properly. And that's a tax law that certainly has affected a lot of people to relook at their actual tax residency and whether they exited and have a certificate for having exited.
And when did that go into effect?
2021.
2021.
So it's just after COVID. And our revenue authorities, interestingly enough, used COVID as a where do you return from in your wanderings? Because in COVID, everybody typically went back to where they could feel safe and was their home. So if somebody came back to South Africa, then they couldn't have said, well, I actually left because, South Africa is my real home. So COVID was used by revenue authorities in another way to say, where do you return from in your wanderings? But certainly I have an inquiry or a consultation, every month with somebody who left in the past, and how do I deal with, getting my affairs in order. And often that person will have a preservation fund or some form of something, and then we can deal with all of that at the same time. So yeah, that's a big tax law that has affected a lot of individuals and certainly expats out of South Africa.
Yeah, we see that a lot at the Wolf Group. I see that come across my desk quite regularly. I would dare say you probably have a pretty massive audience of people that have not done that probably need to do that. So that's I think a pretty massive takeaway from what we talked about here today. Okay, so anyone that knows me knows that I love, knows me personally, knows I love talking about mental health, physical health, functional health. I'm a big functional health guy. I try to work out, 4 or 5 times a week. I try to always read about, things that that are about positivity and, good, strong health. I love your name tag there. It says positive energy makes you happy. When that came on, I was like, wow, okay. Tell me about that real quick. Why'd you put that in there? What's the take there? What's the message you're trying to send across?
So we use for our cell phones or mobile phones, we use a platform called WhatsApp, and that's my status. That stays as my status. Okay. I love being with positive energy people. I think in life is too short to not be happy. You are much more happier if you're dealing with positive energy people. They uplift you. I love it. You say you work out regularly. I'm one of those as well. Every morning, early in the morning, I do my hour of exercise, and I do that 7 days a week. So I'm very much an exercise. I'm very much an exercise person. You would not believe me if I said to you 15 years ago I was a 120 kilogram person, and I'm not that today.
Oh, wow.
So I'm not that today. So to turn things around, I often say to people that I talk with, I had a midlife crisis and I didn't end up with a Ferrari. I ended up with a lifestyle. So a physical lifestyle, very positive. Love that. Love positive energy people. And mental health is a tricky one. You say you talk about that's not an easy one to understand very well for a lot of people, and I'm probably one of those. I'm a very get things done kind of a person. I'm a typical accountant. Tell me your problems, I will fix them. Whereas mental health, you've got to listen, and I don't listen as well. So yeah, but positive energy makes you happy. Choose it.
Love it. Okay, last question for you. So if I'm listening to this podcast, and obviously, Conrad, I'm going to send you a request for a bunch of links, because there's several things I wrote them down as we were kind of going through what we're talking about. I want to put a bunch of links in the show notes, and obviously, I want you to send me some stuff about how people can get in contact with you, like what's the best way to do it. But if I'm going to try to get in contact with you, what's the normal process look like? Obviously, we talked about the KYC rules, but from the moment that I contact you and say, hey, Conrad, I want to talk to you, I want to get a consultation, like, what does that look like to deal with you? How does it look like to sign up with you? Is there an engagement letter I've got to sign? Like, just give me like the 50,000 foot view of what it's like to work with you and your firm.
So typical getting hold of me, you pop me an email, conrad@nexiasa.com. Typically from there, I will have a consultation with somebody before I do KYC anything. Okay. And then when we go down a road of, yes, we can work together, we go down a road of an engagement letter and getting know your client documents and stuff. But by that stage, I understand what I'm looking at in terms of the person, and the person knows what they're looking at in terms of me. And then we either decide to move forward or we decide not to move forward. So that's kind of how it is. Yeah.
Do you do a retainer and then monthly billing, or how does your billing practice normally work?
So we definitely do it on a depends on time spent. So as it's typically time spent, and it's not a retainer. And the reason it's time spent because it depends on the level of what the person wants. So for instance, if somebody comes and says, please, can you exit me from South Africa? I do the driving inside of my practice, but I get my tax compliance clerk to do a lot of the legwork, and we will charge what our combined time spent is in terms of doing that. If somebody wants to know up front what that is, I give them a range of what it might cost. If they then say to us, can you do our annual filings every year? I say to them, well, this is what it kind of costs. And then I get my tax compliance person to do 95% of the work, and I will do the review work to ensure that it's up to what standard I am doing and what my knowledge base is. That's for an individual. I'm also an auditor, so I do company accounts. I do, in South Africa, you got to do annual financial statements and auditing of companies typically. So that's more so my day job. Although I also run a tax practice as well for most of the people that are shareholders and directors in those companies. I also take on private clients as and when people are in need of services, and I found that a lot of the expats in the US connection with South Africa has become more prioritized in terms of things. So I found a lot more of those things coming through as well.
All right. Well, fantastic. Well, like I said to Conrad, and I'll say this to the audience, we're going to link a bunch of stuff in the show notes so that people can access the information quite easily. I hope everyone has found this to be, I know I walked away with several good nuggets of info that I probably didn't know before this podcast. But I want to thank Conrad for coming on the show. Great job kind of going through everything. Super impressive. Would love to have you back sometime in the near future. If something big happens between the two countries, we'll get you back on here for round two and have you go through it with us. So thank you so much, Conrad, for being on the show today.
Pleasure. Thank you.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.